In 2008, the world economy nearly collapsed. We were told the culprits were greedy bankers at institutions like Lehman Brothers and Bear Stearns. But what if I told you that was only half the story? What if the real danger wasn't in the banks we knew, but in a vast, unregulated network operating just out of sight? A system so powerful it brought the world to its knees, and so resilient it's bigger today than it was back then. This is the story of the shadow banking system, the hidden plumbing of global finance that you were never meant to understand. And the scariest part, history is showing every sign of repeating itself. To understand the shadow banking system, we first need to look at traditional banking. For most of history, if you wanted a loan, you went to a bank. The bank took deposits, like your savings account, and lent that money out. It was simple, regulated, and relatively stable. The government required banks to hold a certain amount of cash in reserve, a safety cushion to prevent a bank run. This system, boring as it sounds, was the bedrock of the economy for decades. But in the 1970s and 80s, something began to change. Wall Street got creative. Financial wizards, like Louis Ranieri at Salomon Brothers, started to see mortgages not just as individual loans, but as raw material. They pioneered a process called Imagine taking thousands of individual mortgage loans, bundling them together into a giant financial sausage, and then slicing that sausage into new securities that could be sold to investors. These were called mortgage-backed securities, or MBS. Suddenly, a boring home loan became a tradable, high-yield asset. This was the birth of shadow banking. It took the core function of a bank lending and moved it outside the regulated banking system. Why? To escape the rules. No reserve requirements, no pesky government oversight. It was the Wild West of finance. And for a while, the gold rush was on. This new system exploded in the early 2000s. The key players weren't traditional banks, but entities with names you've likely never heard of. Special purpose vehicles, conduits, and money market funds. Here's how it worked in practice. A mortgage lender, say Countrywide Financial, would issue a loan to a home. Instead of holding that loan, they'd immediately sell it to an investment bank like Lehman Brothers. Lehman would bundle thousands of these mortgages into a complex bond called a collateralized debt obligation, or CDO. To make these CDOs seem safe, they paid rating agencies like Moody's and S&P to give them top AAA ratings, the same rating as US government debt. These supposedly super safe CDOs were then sold to investors all over the world, pension funds, insurance companies, even other countries. But the system needed constant fuel. To buy all these mortgages and create the CDOs, the investment banks needed short-term cash. They got it from another corner of the shadow banking world. Money market funds. These funds, which many people thought were as safe as savings accounts, would lend money to investment banks overnight through something called the repo market. It was a massive, interconnected chain. Mortgage lenders, investment banks, rating agencies, and money market funds all operating in the shadows, all making a fortune, and all convinced the risk was gone. They believed they had sliced and diced the risk away. They were wrong. The breaking point came when the foundation of this entire skyscraper of debt began to crumble. The U.S. housing market. As interest rates rose, homeowners with subprime, adjustable rate mortgages started defaulting on their loans. The raw material for the shadow banking machine had turned toxic. Suddenly, those AAA-rated CDOs were filled with worthless loans. Panic erupted. No one knew which securities were safe and which were radioactive. The value of these complex assets plummeted. The money market funds, which had been lending billions to investment banks overnight, got scared. They stopped lending. The repo market, the essential lubricant of the shadow system, froze solid. This is what triggered the real crisis. Investment banks like Bear Stearns and Lehman Brothers relied on this overnight borrowing to fund their day-to-day operations. When the money stopped, they were insolvent within days. It was the modern equivalent of a bank run, but it happened silently, electronically, and in a system with no deposit insurance, no lender of last resort, and no safety net. The collapse of Lehman Brothers on September 15, 2008, wasn't just one bank failing. It was the entire shadow banking system seizing up, threatening to take the global economy down with it. Governments were forced to step in with massive bailouts, not just for the traditional banks, but for the entire financial ecosystem that had grown up around them. In the aftermath, politicians promised to fix the system. The Dodd-Frank Act was passed in the US, aimed at reining in Wall Street and shining a light on the shadows. It was supposed to end too big to fail and prevent a repeat of 2008. But did it work? Let's look at the numbers. In 2008, the global shadow banking system was estimated to be worth around $62 trillion today. According to the Financial Stability Board, it's over $200 trillion. It hasn't shrunk, it has more than tripled in size. The names and instruments have changed, but the fundamental structure remains. Instead of CDOs backed by subprime mortgages, we now have things like collateralized loan obligations, or CLOs, which are bundles of risky corporate loans. The repo market is still a critical source of overnight funding and non-bank lenders. From private equity giants to fintech startups, now originate a huge share of loans. The risk has simply moved. The patterns are eerily familiar. We see a hunt for yield in a low-interest rate world, the creation of complex and opaque financial products, and a reliance on short-term funding that can vanish in a crisis. The core problem: transforming risky long-term loans into supposedly safe, short-term assets outside of regulatory oversight, was never truly solved. The system is just as interconnected and fragile as it was before. We've simply swapped one potential time bomb for another. The question is not if another crisis will happen, but when, and from which dark corner of this hidden system it will emerge. So, after this journey into the financial underworld, what are the key takeaways? First, finance is a game of what? Regulation closes one loophole, and Wall Street's creativity opens three more. Risk doesn't disappear, it just moves into the shadows where it can grow unchecked. Second, complexity is used to hide risk. The intricate structures of CDOs and other derivatives weren't just for efficiency. They were designed to be so confusing that even their creators didn't fully understand the dangers, allowing them to collect fees while passing the risk to others. And third, the system's reliance on short-term debt is its Achilles heel. When confidence falters, that funding can disappear overnight, triggering a catastrophic chain reaction. The shadow banking system isn't a conspiracy theory. It's the very real and very fragile architecture of modern finance. We fixed the visible cracks from 2008, but the foundations remain shaky. We're all participants in this system, whether we know it or not, through our pensions and our savings. The only question left is, will we learn from the past, or are we doomed to watch it repeat? Thanks for watching. If this video opened your eyes to the hidden world of finance, be sure to like and subscribe for more deep dives into the systems that shape our world.